great future. We're talking real money.
Today's episode could be one of the most monumental episodes in the history of Talking Real Money. Today, we are going to address the proverbial elephant? No. Woolly mammoth? No, Matt. What's bigger? What was a bigger land animal than any of those? Oh, wait, the Argentinosaurus. That was the biggest land animal that ever lived. The Argentinosaurus in the room. That's what we're going to talk about today. Introduce the Talking Real Money podcast.
The Talking Real Money podcast is a show dedicated to helping people make better financial decisions. Hosts Don McDonald and Tom Cock break down complex investing topics into easy-to-understand advice, focusing on long-term evidence-based strategies to grow and protect your wealth.
Okay, it's a little wordy, but pretty much got the facts right. That was ChatGPT.
Yeah. So you went from this huge animal to this little tiny chip.
I know, but it's literally the elephant in the room.
Okay.
It is, because it's suddenly, I mean, we had little things, little semblances of it, like voice recognition. That was kind of an AI thing. They trained it for years and years on how to recognize human speech, but that was really good. And that was untrained and unprompted. That was just ChatGPT looking us up on the internet and creating a synopsis of the show in a language that we didn't write down anywhere. It didn't copy and paste what I have on the website. I didn't have that there. That was AI taking care of business without any special training. It's kind of eerie. But what about money? What about investing? Can AI predict market movements? Wait, I've never done this. Let's do this. Okay, are you ready? Let's ask ChatGPT if they can do it.
Why not? I think it's a great idea.
Can you predict short-term market movements in the stock market?
Predicting short-term market movements is extremely difficult, even for experts. The stock market is influenced by countless factors, many of which are unpredictable. That's why most financial professionals recommend focusing on long-term investing strategies instead of trying to time the market.
And ladies and gentlemen, that's the end of our show. Thank you so much for being with us.
I was really hoping for more of a 2001 answer where she said, "Sorry, Don, I'm not programmed for that," or something like that. More
no,
eerie.
She's very chipper.
Yeah, she is very chipper.
So the question was going to be, can AI predict the stock market? But apparently we put that entire issue to bed, Tom.
But there are things. This comes from an article written by someone we know and respect by the name of Larry Swedroe. And the article's interesting because Larry, of course, doesn't write this from the seat of his pants. He's looking at studies and he's looking at all kinds of data. This is not something he takes lightly. But the answer is complicated because AI, sure, it can do things like, and this comes from the article, superior computational power. It could do that faster than you and I could do, right? It could take Nike and tell you why that's out of favor and tell you why, XYZ Corporation's better. It avoids the cognitive biases that we all have, right? You hope.
True. It has no emotion.
Right. And it's like, because I really love Nike because those shoes are wonderful and I want to own that company. And so there's all kinds of studies, a brand new one called From Man versus Machine to Man plus Machine, the art and AI of stock analysis. I mean, it's pretty interesting. These guys built a AI model to predict 12-month stock returns. And what did they find? They find that, AI can do a little better than the analysts. But then when you add them together, well, it's still, it's not perfect, but it's better because there's some things humans are better at analyzing, right? The institutional knowledge, for example, they say is better with humans than with AI. AI, as I said, is much better at accumulating this data much more quickly. But what does it all mean? Because there's funds right now you can buy that invest in AI, right? There's funds you can buy that use AI. That will help you be a better investor. You could go online right now. I tried it myself. You'd be proud of me, Don. I went to ChatGPT and said, give me 10 stock picks. It had them there in like seconds.
It did give you stock picks?
It gave me stock
it said,
picks.
I can't pick the market?
Yeah, even though it uses quantitative metrics. a quick review of certain factors, and boom, there's your 10 picks. I'm not buying any of them. But this is an argument that will be made ad nauseum moving forward. Can you find a machine that can do better picking the stocks that will outperform the market? That's the key part.
Yeah, there you go. That is actually where the rubber meets the road, as
it
were,
is.
because you've got to outperform, and outperformance is the holy grail of everyone, and no one consistently, repeatably does this day in and day out with a high degree of accuracy. It just doesn't happen. And then when you throw in the human bias thing, it's a mess. I can see why AI does a little better, because the emotional component has ceased to exist.
And the other part, according to this study, is that AI-powered funds outperform their human managed peers because of lower turnover, 31% versus 72%. That's saves money, right? Lower transaction costs, marginally superior stock selection skills. Interestingly enough, AI picks fewer stocks than the analysts. Their portfolios are more concentrated. AI-powered funds avoided some prevalent behavioral biases, which is what you just referred to. But according to the authors, a combination of AI and human beings can do better than just one or the other. But what does that all mean? It doesn't mean very much.
Do we still get results, though, that are better than just database, scientifically rules-based, I should say, investing or index investing? Either one.
It does not
answer
that.
Can we get better performance than
It does not
those?
answer. I'm sorry, Don, that doesn't compute. I can't tell you that. This is always where, as you said, the rubber meets the road, right? This is what people want to know. Hey, if I just turn my money over to this machine, it'll do better than my broker because it has these advantages. It's faster. It doesn't have these biases, et cetera. We can't find that out right now, but you want to ask the machine if it can give it to us.
Will AI managed mutual funds outperform index funds?
It's hard to say for sure. AI managed funds might have the potential to spot trends and react quickly, but outperforming index funds consistently is still a big challenge. Most active funds, including those managed by AI, struggle to beat simple, low-cost index funds over the long term due to higher fees and the unpredictability of markets. Ultimately, only time will tell how effective AI will be in this space.
I'm sorry, Don. I'm going to have to shut down now. You just closed them all down, man. Computers are clicking off.
Tom,
yes.
Tom, who records all this and controls the recording of the podcast?
Ooh, that would be you.
That would be me.
Yeah.
I think I found my new co-host.
I'm out. She's chipper. She sounds younger.
Yes.
It's just better.
Her answer was very well thought out.
I thought it was, frankly. I'm feeling
really
a little nervous here.
She's, wait. I want to ask her another question. Hold on.
Please. Can I replace my co-host?
Which host is better on Talking Real Money, Don McDonald or Tom Cock?
It's actually Don McDonald and Tom Cock, who co-hosts Talking Real Money. Both bring valuable perspectives. Don has a background in financial education and broadcasting, while Tom offers deep experience in investment advising. Deciding who's better is subjective and depends on what you're looking for, but they complement each other well.
That's pretty good. That's scary.
I gotta tell you, she's more
running
diplomatic.
for office. Yeah.
She's more diplomatic than Tim Walz and J.D. Vance were.
Yeah, very much so.
I'm wow.
That is
wow.
Good. That is
okay.
Right
You
down
get
the
to
middle.
be the new host of Talking Real Money, OpenAI. Go ahead.
Haha, thanks for the promotion. I'll do my best. Welcome to Talking Real Money, where we cut through the confusion and
Wait, stop.
Whoa.
She
We're going to
did
be out.
take over.
Yeah.
She totally took over.
Now I'm getting very nervous here.
Did
about
you
all
notice
this.
she was ready for the job? She went right into introducing the program.
Not messing around, takes right. Yeah, that's kind of scary.
All right. I have to tell you, this is really important. This is truly important. I am glad we are nearing retirement.
The machines are winning.
Kids, you're in trouble.
Yeah, exactly. Let me give you another takeaway, though, from all the studies and stuff that I think actually probably works in favor of those who use index funds or rules-based funds. The overall consensus, if you go back and read other folks talking about it, is about using AI when it comes to picking stocks, markets, et cetera, is that the marketplace will now be even more efficient. Things will happen more quickly. Prices, so because the market always needs something to respond to, right? And it's how fast you respond to that.
This will really make it faster.
This will make it faster. It'll be harder to be ahead of whatever response to a particular event takes place.
Do you know how many years it would have taken me to train a new host for this show?
Boy, and let me tell you right now, there's not a lot of people right outside this door begging to jump in. So maybe the AI thing would
ready.
She's ready to go.
And the funny thing is with a flip of a switch, I can make one of her a man and one of her a woman.
Whoa, now we're getting really scary here. You know what this actually, after reading all this and reading and there's a great article if you want to dive into it. It's free, by the way. You can go to Morningstar and read it. But after reading all this and reading responses to this and other things, it reminds me, and I know you're going to laugh because you probably don't remember. You remember the movie War Games back in 1983 with Matthew Broderick?
Yeah.
And you remember what the Whopper
under
computer,
Cheyenne Mountain.
Yeah. Do you remember what the Whopper computer says at the end?
No.
Best not to play the game. Maybe it's just better not even to play the game. That's what it says when it finds out.
That was too much fun. I'm going to do that again. You know I'm going to do that again.
Exactly.
No,
but the point is best not to hire a machine to try to pick stocks, time markets, do all those things. Instead, just accept index or rules-based like returns.
Yeah, I guess I shouldn't ask ChatGPT which stocks it picks, because that would be bad for the show, right?
That would be really bad for the show.
Yeah, so
Plus,
we're not
she sounds really good. I think we've had enough for her. She's out.
You sure?
Yeah, she's done.
I don't know. I'm thinking now next time you take vacation.
You're going to co-host.
Wait a minute. Oh, wait. October 12th.
That's
Tom's
right.
going to the Raiders game.
Yes, I will be
My
out of
co-host for the October 12th program will be ChatGPT.
Stand by for that. All right, let's get to.
Actually, that's going to be great. Oh, now I'm really looking.
Now I'm
going to
have to listen.
Show.
Let's go to a few questions, of which I'm going to answer, not the computer. And these come in from talkingrealmoney.com. So please continue to send them to us. Jeff from Jefferson, Iowa writes, always get great info listening to your podcast. I'm retired, but not 65 years old. I cannot add to my existing individual retirement accounts, so I opened a Fidelity brokerage account. It mirrors the index funds I have in my IRAs. Is there a rule of thumb on what should not go into a brokerage account and timeline the money that should be committed to the account 3 years or longer? He says he has money market account for short-term goals and an emergency fund.
Yeah, money market's great for short-term goals and emergency fund. A money market fund, high-yield savings, whatever that might be. Even a combination of money market and short-term bond funds or a CD ladder or whatever. But are we also talking about the other assets and which account they should be in, whether they should be overemphasized in the IRA or overemphasized in the brokerage account? I mean, I'm not sure what the rest of the question is.
Well, the rest of the question refers to the types of things he should own in the brokerage account. Mm-hmm. And then also maybe what the stock to bond ratio there should be, because if he has to start drawing on that earlier, in other words, he's kind of asking about timeline. So, because he said 3 years or longer, I personally think if you're going to be in stocks, you should give yourself probably 5 years. In other words,
longer.
Yeah, because you really shouldn't be investing in those if you need the money within the 3 years. And then in terms of what you could own in the brokerage account that you might not own in an IRA, well, the IRA is better from a tax standpoint to have the fixed income, right? Because the interest then is not taxable, where it would be in a brokerage account. But that's a small thing, a bit of a nit. You wouldn't want to hold REITs in a brokerage account if you could avoid it as well. But overall, I think the bigger question really, Jeff, would be how long till you need the money? If it's within 5 years, the amount you're going to have in stocks is going to be relatively small.
Where should you have various asset classes between an IRA account and a brokerage account?
Generally, it's best to put investments that generate a lot of taxable income into your IRA or other tax-advantaged accounts. Meanwhile, tax-efficient assets like index funds or growth stocks can go into your taxable brokerage account. This strategy, called asset location, helps you minimize taxes and maximize growth across your portfolio.
We're in so much
She
trouble.
stole that from me. That's exactly what I just said. She was listening.
We're
in the
so
walls.
we are in so much trouble.
It's over. Okay.
Oh my gosh.
We're friendlier.
I would not want to be in the
but she's not
financial
friendly.
podcast business after the next year or two.
Sorry, I'm sorry,
folks.
Don.
It
You're
was
no
nice
longer
knowing
needed.
you.
Exactly. All right. Betsy from Lakeville, Minnesota writes, I have included a communications and technology ETF in my portfolio for the past 10 years. The ticker is V as in victory, G as in good, T as in Thomas, VGT.
Yep.
It has outperformed all other ETFs that I own. I realize that values outperformed growth in the past, but don't we need to be more forward thinking? The world's a different place than it was in the 70s and 80s. Instead of American Express, it's Apple. Instead of Ford, it's Nvidia. VGT and QQQ beat the S&P every year. Should we avoid them simply because they are a sector play? Can you discuss this on your show?
Yes, you should avoid them because they're a sector play.
That was easy.
The fact
QQQ, by the way, is the NASDAQ 100, yes, I believe.
The
correct?
NASDAQ 100, which is mainly tech stocks.
Yes,
but,
mainly.
VGT is the Vanguard Information Technology ETF. Now,
it's done pretty well, is my guess.
It has done very well, but the reality is this is part of our emotional bias that we talked about earlier. We get too hung up on short term. And the reality is it's done very well in the short term. Now, it really doesn't have too terribly long a long term because it's an ETF. But it's done very well because that segment of the economy has done very well. But what happens if that segment of the economy is usurped by something we didn't see coming?
Surprise.
The trick is seeing it coming, and the definition of not seeing it coming means we don't see it coming.
Why don't you ask your friend on the computer there what's coming next, huh? What's the next big surprise down the road that we're not anticipating right now?
Maybe she knows.
If she does, we're going to trade on that like nobody's business.
What's the next big sector that we are unaware of in the investing arena?
One emerging sector that many investors might not be fully aware of is the clean energy and renewable technology sector.
No, we know that one.
That's
we
old play.
We knew that one. We knew that one a long time ago. That was the whole.
She's looking outdated now and a little slow.
She's looking a lot outdated. The fact of the matter is, you're not going to do that. But the reality is, if you have a well-diversified portfolio where you own all the stocks in the world, or most of them anyway, you're going to own this segment of the market along with whatever segment of the market is coming. And that is where it's important. This is why overweighting small, particularly small, has been so effective over the last, 10 years? No. 15 years? No. 20? No. 100 years.
Almost 100. We're just shy of 100 years now.
We're 2 years shy of 100, year and a half shy of 100.
Yeah. So you've won.
That is a long-term track record. The other stuff is, 1, 2, 3 years is noise, but even 10 or 15 in the grander scheme of things can be not nearly enough time, particularly when it comes to focused bets. And that's what this is. This is a focused bet. And by the way, one you've succeeded with.
Yeah. So take your money.
Right. What do you do? Let's remember the old Kenny Rogers song, The Gambler. Know when to walk away.
Yeah, and that would be important here. So, this is a sector play. Yes, we still believe in the S&P 500, but as Don correctly points out, we believe in the S&P 500 and a lot of other stocks, small, value, international, all those other places you should own. So, congratulations on the great work there, VGT and
the great
QQQ,
luck,
whatever it was. But get your money, Betsy, and rebalance to a more diversified portfolio.
Exactly, because there will someday, very likely, come a day when you'll be glad you did that. And again, this goes back to our way of thinking. We don't want to just accept good enough. We want the best, and we want it all the time. The problem is you get the best sometimes, and then sometimes it turns for the worst. So, I wouldn't. Let's see, really quickly. Is there anything you'd like to add to Talking Real Money before we finish the show?
Just a reminder to always do your research and stay informed. Financial literacy is key to making smart investment decisions. And don't forget to stick to your long-term goals, even when the market gets volatile. Thanks for tuning in.
I think we're done, dude. It's over.
She said, thanks for tuning in.
That hurts. I'm out.
She actually knows how to end a show. Oh, my gosh. It's over. All right.
I'm sorry, Don.
We're going
to have to disconnect
you can still go
now.
visit the human-created website,
You'll see our
Talking
pictures
Real
there.
Money,
Yeah.
and speak to a real-life human advisor over the short run until they're all obsolete. Well, the next advisor meeting, you ought to let them know.
Yeah, we did this and time's up.
Yeah, we didn't realize until today that all of our times are up. So it's nice knowing all of you.
Call while you can still get
Go
a
to
human.
talkingrealmoney.com. Call us at 855-935-TALK on Saturdays. Please. We'll be human, I promise, for a little while anyway. And if you want to talk with one of our advisors, it's free, because what are they worth nowadays? Might as well just give their stuff away for free with no obligation and no high-pressure sales pitch. I'm Don. What's your name again?
It doesn't really matter at this point.
Does it?
See you later. Yeah.
Yeah, we're for the next few minutes anyway. We're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?